$500,000. That's the typical tech-heavy portfolio size for a 40-year-old working at Apple, Google, or Meta. Today, that portfolio feels safe. Nvidia's up 80% year-to-date. Microsoft's humming. Dell just hit a record high, but insiders are watching something else. Capex announcements buried in Q3 earnings transcripts, and margin compression is coming fast. Most investors don't realize that record-high stock prices often precede the worst earnings warnings. And here's the thing. You probably won't see it coming until it's too late. Dell's rally masks something critical. The company, along with Nvidia, Broadcom, and cloud infrastructure peers, is about to spend $12 billion annually on AI capex through 2026, according to Morgan Stanley estimates. That's not speculation. That's in the 10Ks. Historical data shows this always crushes operating margins by 300-500 basis points within 12-18 months. Translation: a $500K portfolio concentrated in semiconductors and software could lose $75K, $125K in realized value. And if you try to rebalance by selling winners, capital gains taxes jump to $11K, $25K depending on your cost basis. But wait, there's a third hit most people miss entirely. Here's why this matters right now. Most tech workers don't act until earnings warnings hit. By then, the stock has already dropped 15-20%, your portfolio has shrunk, and you're forced to realize losses on inflated prices, or miss the recovery rebound entirely. That's a compounding mistake that costs you twice, once on the stock price decline and again on taxes. Let's decode the signal. First, the capex language. Open Dell's FY 2024 10K. Look at page 47, the capital allocation section. Dell states, "We continue to invest in AI infrastructure, server technology, and supply chain resilience." That's code for capex is accelerating. Cross-reference this with Nvidia's Q2 2024 earnings call. CEO Jensen Huang says, "The next phase of AI adoption requires unprecedented infrastructure spending." Broadcom's CFO echoes the same message. Now pull the historical data. The last semiconductor capex supercycle was 2007-2008. Margins in that sector contracted 430 basis points over 18 months. The cycle before, 1999-2000, saw 520 basis point declines. What does that mean for earnings multiples? Research shows tech multiples typically contract 15-25% when capex-driven margin compression hits. Applied to a $500K portfolio, $500K times 20% contraction equals $100K loss. You're now sitting on unrealized losses. Panic selling is tempting. But here's the trap. If you sell winners to rebalance, you owe capital gains tax on the gain, not the loss. Let me show you the tax math. Assume you bought Nvidia at $125 years ago. Today it's $850. Your unrealized gain, $730 per share. If you own 300 shares, that's $219,000 gain. Long-term capital gains tax federal plus state, 15-20%. $32, $850, $43, $800. To rebalance a $500K portfolio, you might sell 50-60% of tech exposure, triggering $11K, $25K in capital gains tax alone. That's a 25% after-tax penalty on top of the margin compression risk, and that's before accounting for state taxes in California, 13.3%, or New York, 82%. Now here's what separates winners from bag holders, the open loop that nobody addresses. How do you spot the exact timing of margin compression before the market panics? SEC 10K language reveals it. Dell, Nvidia, and Broadcom all bury capex guidance in 3 places. 1. Management's discussion and analysis section. 2. The cash flow statement. And 3. Footnotes on long-term commitments. When capex as a percentage of revenue crosses above the historical 5-year average, you have 4-8 weeks before analysts start asking about margin pressure. That's your signal window. Second pattern, earnings call language shifts. Listen for CFOs saying near-term margins will be pressured by investment or capex will remain elevated through date. That phrase, elevated through, is a red flag. It telegraphs the exact quarter margins will crack. Broadcom just used this language in August. Dell repeated it in June. That's a 12-week warning signal. Most retail investors miss entirely. Third pattern, and this is the one that pays off the biggest. Watch for guidance reductions paired with capex increases. When a company says, "We're investing $10B in capex while reducing full-year revenue guidance," the stock typically drops 18-22% within 4 weeks. That's your exit signal, or your entry point for hedging. Now, the actionable question. Should you rebalance now or wait? Data suggests this. If your cost basis is low, under $300 per share in Nvidia, for example, holding through margin compression and capturing the recovery rebound, historically 9-18 months post-compression, outperforms selling now and paying 20% in taxes. The math. $500K held through compression plus 12-month rebound equals $575K, $625K after taxes, versus selling now, paying $25K in taxes, and sitting in bonds at 4.5% yield equals $475K capital remaining. But if your cost basis is high, bought in 2024, the tax liability is smaller, and rebalancing